Welcome to OpenSociety.wtf, a podcast where we explore how today's technology shapes our world, both in building a more open digital society and in creating its opposite. We talk to experts in biotech, Web3, and AI to find out how these innovations are impacting our daily lives. Yesterday, I went through your videos. I think your background is very interesting.
I mean, decentralized stablecoins have kind of struggled to like actually compete. Maybe like a good example here is one is on risk. You can potentially do actually like quite a lot better than things that are off-chain stablecoins.
And I think I learned a lot today. Yesterday, I went through your videos with economic designs, your PhD presentations. I haven't gone through your DEF CON video though, and looked through your resumes. I think your background is very interesting because you studied obviously mathematics, graph in specifically for complex systems like the economic systems, and you talk about the 2008 crisis and also how Soros shorted the English pound, which is quite interesting. Like we can use that as a kind of case studies for non-custodial stablecoins. And I think we can start with your background in terms of complex economic system design and how you kind of developed your ideas of design systems or kind of reduce the shock to the systems by but anyways, I think you are more expert in that area, and I can give the stake to you. You can talk about that and how that led to specifically stablecoin designs and made you want to change your mind of not staying academics, but rather to being a founder in the Web3 space and design your own economic systems, which I found it quite inspirational. Yeah, so if you could give me a kind of how this transition worked for you and why you are so interested in complex economic system designs and your insights about the graph behind it.
Yeah, thanks. Yeah, I have kind of what I think is like an interesting background, I guess. Kind of went in and out of like a couple of different topics and things in theory and things in practice, and then like ultimately like aim to bring everything back to something in practice. But I started like in like pure math, and did some pretty pure things like number theory for quite a while in like undergrad. And following that, I did a bit of work in practice in like finance and like economic modeling after undergrad. And uh, in the course of doing that, like kind of ultimately like brought it back to like kind of like trying to make better models and like kind of inspiring me to like do kind of more complex work and kind of like seeing like a lack of 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 being able to do practical things but with like complex models, and ended up kind of working a little bit in like ETF design as well as like some mortgage-backed security modeling, but ultimately became like kind of most interested in the modeling space and kind of like making my own sort of like new models, trying to fill these sort of gaps I was seeing, which like ultimately led into deciding to do a PhD to like focus completely on making those sort of models. And what I started on, what you were mentioning before, are these like graph theory sort of models of complex financial systems. So this would be like a kind of like you have a network of different types of firms, for instance, and these firms, there may be like many of them, so it might be like quite a big system, and you may have different types of contracts or relationships between the firms, and now you want to understand like how risk can filter through this system and kind of the dynamics of what can unfold in this system. And it's this area that is like economics, but complex enough in terms of like being able to actually compute things that it becomes like a computer science problem. And so that's like basically where I focused for a PhD, is on this like these types of economic problems that are also like basically computer science problems to solve. And in the course of that, uh, like when I was kind of coming out with like my first papers in that area, was about the same time that Maker was coming out in crypto. So this is like 2017, 2018, and uh, I mean I was always interested in crypto, but like this became like a real grounding point of like something that was like another like example of where there was like a missing model, and something complicated was kind of like happening and was worth studying and had like probably practical consequences of studying. And so I like also took that on as like an extra area in my PhD, and that led to a first paper that was on kind of like the dynamics of DAI and characterizing what I called like deleveraging spirals, which is basically like a short squeeze sort of effect. Basically, if you have many people in the DAI system who want to deleverage their positions and so like pay back their DAI debt, at the same time, it can cause this like short squeeze effect that causes the price of DAI to spike, and it also like injects a bunch of risk into the system basically. And so this was like a theoretical paper, but like it actually turned out to happen in like about a year later on Black Thursday in 2020. So that kind of solidified like kind of my interest in stablecoins, because like here was something I saw was like kind of like a an open field. Like you needed some new models to better understand it, and then it has like immediate practical consequences. And we kind of expanded the work also into things like Terra, and kind of like predicting the issues that would ultimately end up in the Terra collapse, and ultimately like motivated me and my co-founders, who were also PhD students, and we worked on some of these papers together, motivated us to build Gyroscope as like kind of the way that we saw of like best making a new stablecoin to avoid the problems that we were seeing.
Right. So before we dive into stablecoins and your thoughts about particularly non-custodial stablecoin design, we can talk more about what's your thinking about. Can you define what complex system is, and do you think it can be controlled, or the risks can be absorbed through artificial systems, through maybe artificial interventions?
Yeah, I guess there's probably not a great like definition of a complex system, but I mean you can just think of it basically as something that's kind of computationally complex, I guess, or like requires some new infrastructure, I guess. But the infrastructure is like computer science infrastructure to be able to understand what happens. And there's many different types, but the ones I like focus on are financial ones. There's I went through, I guess, the example of like the complex network of like financial firms, but you can think of something similar in crypto and like DeFi in particular. You can think of all of these different like DeFi protocols, and you can think about the connections between the different DeFi protocols. I mean, everybody talks about like money Legos basically and building things on top of each other in DeFi. It's kind of like quite one of the big innovations, I guess, innovation potentials of DeFi, to be able to do like all of these things and interchange different parts and do money Lego stuff. But it also potentially puts a bunch of risks, like stacks them on top of each other, and you want to be able to like understand it. And understanding how all these different DeFi protocols interact with each other is also like a complex system and kind of a complex problem to understand everything that can happen.
In your previous presentations, you compared traditional money with non-custodial money like DAI and other non-custodial stablecoins. Um, can you elaborate more on how both are on itself complex systems, but with the different makeups?
Yeah, so in non-custodial stablecoins in particular, I suppose, you have a bunch of different like agents or other protocols maybe in some cases, but like you can normally think of them as agents doing different roles and being connected through the system. So if you think of like the simplest case of like the original DAI system, I guess, which was basically connecting borrowers and or well, stablecoin holders as kind of like borrowers and people who are trying to get leverage on crypto assets. And so how it would work is you would have somebody who wants to speculate on the ETH price, and they want to to achieve leverage on the ETH price. They come in with some ETH collateral, and they borrow like DAI into existence against that collateral through like an over collateralized loan, and then they sell that DAI to somebody who wants to hold the DAI or use it as a stablecoin, and then they buy ETH with it basically, and or that's what they would normally do, and then they have a leveraged position in ETH, and maybe they like wrap it a few times to go even further. But this is like kind of just like a simple setup so far, but you can have many of these different people trying to take leverage. That like adds a bit of complexity to the system because you have to understand how all of them are going to make decisions and might like kind of uh, cause problems in how they make decisions. And then you also have to understand kind of the demand side of DAI and how much demand there is actually to like be a stablecoin holder, and what you can do with DAI, and also like as it turns out for things like deleveraging spirals and what happened to DAI on Black Thursday, um, when that DAI might be like illiquid in how it's being used can have a big impact too. And so like all of these different components, if you want to like model all of it out, it's like very complicated. Gets complicated very fast.
Yeah. So in comparison, traditional money also have it's also very complicated. And in that case, what would be the Black Friday case for traditional money in comparison to the Black Friday case for DAI, and what are the kind of the trigger for in both cases respectively, and how are they similar in some ways?
Yeah, the all of finance is basically very complicated. Um, Most people don't really understand like how the banking system works or how like the monetary system works. They know like the interface kind of for how they interact with it, which is normally through a bank. But they don't know like what happens under the scenes, and so you can think a lot of people might think that it's like not complicated compared to crypto, but actually it's like just as complicated or even more complicated. It's just that you don't really see it normally. Whereas in crypto, like one of the nice things about DeFi is you can actually have all this transparency and actually see like how all of the things are plugging into each other, which is, well, I guess one of the innovations and very nice thing to have, but also just like if you're new to the space and you're looking at it, it's just kind of like information overload, and you might think it's just more complicated than other things, but in truth, everything is complicated. And this is one of the main like motivations behind like our work and like also like kind of what we're doing for Gyroscope is basically there's a lot of work already in finance and economics, and we should be learning the lessons of that work already. Now you may have to like change some models because some things do change in crypto compared to like the traditional models. But either way, there's like a good starting point and a lot of good lessons already to bring in. And an example, I guess, is basically like currency attack models. So this was the example you brought up earlier about like George Soros breaking the Bank of England and the British pound peg. Um, this there's already like quite a lot of good models to help understand like the actual mechanics of this and when a Soros attack is profitable and so like kind of like will happen and when it's not and kind of like how to design like a currency's monetary policy kind of considering this sort of attack potential and unfortunately like a lot of stablecoins were rolled out without really like taking those lessons into account in terms of how they designed the systems that they launched. And I think Terra is a kind of like a good example there. Basically, they launched a system that looks, on the surface at least, you can apply like some of these models kind of directly and understand that you can have basically a depegging attack, which is either an attack or it can also just like happen on its own because it's an under collateralized system trying to maintain like a one-to-one peg and you can just apply these models kind of directly and understand that you're going to have kind of this spiral to zero sort of risk if you commit to this design that the Terra was basically committing to. And so it's a bit unfortunate that was like rolled out, that it became so big, and that these lessons weren't incorporated earlier, and a lot of pain could have been avoided.
Yes, I think in the space, I haven't really seen a lot of founders like you who does such extensive research on stablecoins. And before Gyroscope, you also mentioned that there's kind of a universal design scheme for non-custodial stablecoins, in which you denote two terms. One is tangible, another is non-tangible, and you notice that Terra UST it only focus on the tangible part without noticing the intangible part. So can you elaborate? Can you apply this universal design? Maybe first briefly introduce such universal design in non-custodial stablecoins and apply that to the current landscape we've seen in the space, such as DAI and recently Athena, Frax, and then we could go on to Gyroscope, how its primary secondary market design it's different from the current ones.
A decentralized stablecoin or a non-custodial stablecoin. The most important things to think about probably, like if I just want to highlight two main things. I mean, there's a couple other like things to think about too, but like no need to focus on everything. The two most important things I think are one, like what is actually backing the stablecoin in terms of assets, and two, what is the like issuance mechanism for like how do new stablecoins come into existence? How do old stablecoins disappear basically when what happens in like the is there like a redemption process or when do they get taken out of circulation and most issues that have come up in existing stablecoins like you can trace back to mainly like one of these mechanisms and how it was designed in terms of what's backing the stablecoin I think the most useful distinction is to think about what we call exogenous collateral and what we call endogenous collateral. And this mainly focuses on like, does this asset like have a purpose, like exist kind of outside of this system, or is its value like kind of defined by the existence of this system? Almost make it like an equity sort of token in the system itself. And if you have kind of this latter case, this kind of like circular derived value, it means that you have this spiral to zero sort of possible outcome, the sort of thing that happened in Terra, but also happened in like a bunch of other kind of every other stablecoin that basically used or still uses endogenous collateral. And
Oh, just
this
to interrupt.
oh sure yeah.
Endogenous, do you mean that it's backed, so the stablecoin is purely backed by cryptonative money?
Not exactly. So as an illustrating example, um, some stablecoins you might be backed by ETH, and other stablecoins you might be backed, or in Terra's case, the original design, it's like kind of in effect backed by Luna. And in the case of ETH, it like has a value independent of what happens to this stablecoin. So DAI is an example here. Its price might be volatile, very volatile like ETH, but like it has some value for a reason that's like independent of this stablecoin, this system in particular. And comparing to Terra, Luna like really doesn't have any value unless the Terra system like is working and like growing. And if it is, it's kind of like circularly valued. And if it's not, or if like the consensus outcome kind of becomes that it's not valuable, it can go to zero in like a spiral and bring down the whole system with it. And that's effectively like what happened in the Terra Collapse. And so it's why we caution against using endogenous collateral, especially as like a primary mechanism. We also think it's like rather sketchy. If you actually like boil down the mechanics of what's happening with something like Terra, it looks a lot like a Ponzi scheme, basically. Like if you boil down how all everything's like how it all works, like, and you ask the question, what happens when new money comes and enters the system, and you boil down like all the mechanics, you come up with what happens to the new money is it exits the system and pays back old investors, basically. And that's what makes it like very sketchy, because there's not really like a great reason to do that. You could be doing other things with these assets, which is this whole other design space of like reserve-backed stablecoins.
Okay, so meaning that if it's endogenous, it's backed by its dependent tokens, which you cannot, once you collateralize, you cannot do it with other systems, which makes the system a bit simplistic. That's why it's quite fragile. So we need something more complicated in the exogenous kind of sense.
I guess you can think of it as more complicated, as in like you have to consider contexts outside of like your system. But you can also think of it like in a just simplified way. You have an asset, it has an outside reason for being valuable. That's an exogenous collateral type. You have an asset and it doesn't have like an external reason for being valuable. It only has value because like it's like circularly valued. Like the point is, it's like the whole thing is circular, and so it can collapse to zero. Like that's just like a possible outcome, and that's the endogenous collateral type.
So how is exogenous non-circular?
Um, so if you think of like ETH, uh, like it has like other use cases. Um, I think, of course, if you go far enough in like any sort of monetary system, eventually you come to something that's like a coordination game about like why something has value, whether it's like a dollar, whether it's gold, whether it's ETH, Bitcoin, whatever. And so like if you go far enough, you end up with like something that's like this like kind of monetary coordination game. But if you don't have to like I guess like worry about that. Like that just exists, and so like um, what's relevant though for like this system is like what's less fragile, mainly something where the coordination game is already quite strong, and like so there's like kind of a reason for it to have value, and like probably it'll continue having value, or you're just making up a new coordination game, and so it's like actually quite weak and likely to collapse. If you want to get like into kind of like the real technicals of monetary systems, like I guess you always end up with something that looks like this. But some things are just stronger than others. And if you can build on the stronger foundations, like your system should be stronger.
That's quite interesting. So, because in the current space, we've seen DAI, Frax, and now Ethena. And what are your opinions for of the three, and that led you to build Gyroscope?
So DAI has had an evolution of its own. Maybe it's worth highlighting that, and then can like also show how Frax kind of fits in this sort of evolution too. And Athena's kind of a case of its own, so maybe I'll talk about that afterward. For DAI, if you start with like the original DAI design, this is what we were what I was studying in this like early paper, and was finding this like deleveraging spiral effect that then happened. After it happened, DAI underwent a pretty big evolution in its actual design. It stepped back from this from only having this sort of like leverage backed side of the system and added the PSM. So PSM stands for Peg Stability Mechanism, and it's based for DAI. It's basically allowing exchangeability between DAI and USDC. So it when you introduce this, it overcomes this like short squeeze effect, because now if everybody wants to deleverage their positions and so like kind of pay back their DAI debt, if there is a short squeeze effect and the price of DAI goes up, then somebody wanting to deleverage instead just comes in with USDC and swaps the USDC 1-to-1 for DAI, and so the deleveraging, the spiral effect goes away because you have this link back to a dollar, and so the price has like a hard cap. It's not going to go above a dollar because you have this convertibility feature. And so that's why you don't really see deleveraging spirals anymore in DAI, but it comes at the expense of basically all this centralization risk. And at times, DAI can be like mainly backed by USDC. This would kind of led to like another sort of like crisis in DAI, when everybody was asking like, well, why hold DAI if it's like more than 60% at times just backed by USDC? And then DAI underwent like a further evolution into backing with like also real world assets, so things like treasury bills. And so now DAI is kind of this like hybrid sort of stable coin, where it's like partly backed by treasury bills and partly backed by this crypto leverage mechanism. And this isn't to say that it's like bad. It is just to say that you have risks coming from each of these different mechanisms, and when you're evaluating like what is the risk of DAI, you then just need to think about the risks of all of the backing and the different issuance mechanisms. Now, Frax ended up evolving into something that looks like actually like very very similar today in terms of like backed by quite a lot of real world assets. But it started as basically something that looked like Terra. And so I was quite vocal that this was a bad design when Frax came out. But it was basically saying that you're going to have kind of partial collateral instead of Terra, which was backed by like no collateral or only endogenous collateral. The original Frax design was to be backed partly by like USDC and partly by endogenous collateral. But this is like not really that different from Terra. You can apply the same sort of like Soros attack sort of models and understand that you have the same sort of like depegging risk because of this like this dynamics similar to what was happening with Terra. It's just now like part of the backing, not the whole backing. And since Terra collapsed, and also like a lot of Frax clones collapsed, like they've been trying to move away from this as well, and making some progress towards something that looks that's starting to look closer to fully collateralized now. And so a lot of decentralized stablecoins are moving toward like things that look like similar in terms of like these reserve backed sort of designs. You can think of both Frax kind of like becoming that, as a large part of DAI becoming that, and that's where we were aiming to introduce the most innovation with Gyroscope. Basically, build what we're aiming with Gyroscope is build what we think is the safest the safest stablecoin, something that can put risk control on autopilot, as we like to say. Um, uh, but does it through this like kind of managing of a reserve-backed system, uh, and also managing of kind of like the liquidity into and out of the system. I can also mention Athena, I guess, since you brought that up. It, as I said, it's like a bit of a different design because it's actually like a centralized system, more or less. Um, you could think of you can think of it as like its own form of a leverage mechanism, I suppose. It's based on like what's called like a perpetual, um, which is you're trying to you're pairing a long position against a short position, what Athena's trying to do, and hoping that the net like interest payment on both positions is positive, and then paying that out as yield. And how Athena does this in a like scalable way is by not doing it on decentralized exchanges where there's not a lot of kind of like actual liquidity yet, but doing it on centralized exchanges. And so that's why it's like kind of a centralized system. It's basically a centralized like strategy for doing this sort of like a carry trade on centralized exchanges. And it also has its own risks. I mean, it has kind of like the centralization sort of risks, as well as the risks of the strategy itself. And one of the big risks of the strategy is that the net interest rate might not be positive all the time and might be negative. And what happens when it's negative? And is like the peg maintainable when it's negative? And it might not be. And you can kind of have volatility, especially in those sort of settings.
Right. So from what you have just said, DAI is not entirely non-custodial. It has a reserve mechanism since the Black Friday. Frax is not either, and Ethena is centralized. So it seems that the current non-custodial stablecoins have both centralization risk and also decentralization risk. Um, so how does Gyroscope circumvent the risks? And I think you guys also has this reserve mechanism with backed by some of the centralized stablecoins like USDC and USDT.
Mhm. Yeah, exactly. So the approach we take in Gyroscope is basically uh, build something designed from the ground up with like just the reality of what the risks are and build it in a way that manages those risks to the best extent that you can. So we definitely don't want to claim that like all the risks go away. Like that's just impossible. Um, but you can better manage the risks than just doing the very naive solution, which was like the original PSM for Maker. You can do a lot better. And so that's like been our whole motivation with Gyroscope is building the infrastructure to be able to do that better. And what we like in particular like want to address with like Gyroscope's design is we want to address risks becoming too concentrated in like the assets backing the system. So in comparison, like the very simplistic PSM in Maker ended up taking on just like excessive USDC exposure, which was quite detrimental when USDC depegged and kind of like triggered like the kind of the next evolution in Maker to move away from only USDC backing. Another issue is that governance in like the simplistic designs uh, is both slow, but is also like required to like respond to things in the system. So an example would be also Maker back in this the USDC depeg last year. Um, this the price stability of DAI in that DPEG relied on maker governance, like coming in and making like a split-second decision, which is something we don't think like decentralized governance is good at. Decentralized governance is kind of like a messy process, and we would prefer to have if kind of automation around if the monetary policy or like policies about the system have to change, like because something happens. So something like the USDC DPEG, we want it to be automated so that governance doesn't have to step in and make it happen. Governance just has to like agree ahead of time on what the policy like what the automation like needs to be, and that's like one of the tenets of that we built into the Gyroscope design. Two other issues, like all of these issues came up in the USDC DPEG. It's a great example of like why you need stuff like Gyroscope is building. But the two other main issues are around what we call oracle risks. So this is how do you actually price the assets that are backing your system? And in crypto, you need what's called an oracle to do that, to tell you what the prices are. But most oracles today are just basically like a multi-sig security model, and we think you can do better than that. And so we built kind of like an extra system of that takes information from like a number of different sources, kind of balances a couple of different like information security models, and you can think of it as just like a layering of like extra checks to make sure that like the pricing that you're being fed into the system actually makes sense, and cautions the system to not make extreme actions if something is inconsistent about the pricing, or else like if it is consistent about the pricing, then you can feel more comfortable that the protocol is not making a mistake based on asset prices. And the last one I want to highlight is basically the kind of decentralized liquidity problem. Like it's hard to bootstrap liquidity, but at the same time, like a lot of the like market shapes for decentralized liquidity essentially route through like USDC or USDT. And if something happens to USDC or USDT, it can take down most liquidity channels. And then all of a sudden, even though you may have like a bunch of like assets locked in AMMs, you may not be able to actually route trades efficiently. This was another thing that happened in the USDC DPEG. And so one of the things we also like we're aiming to do with Gyroscope is just like make that trading infrastructure just a little more robust in its shape, so you don't have kind of this whole shutdown of the liquidity system just because one asset depegs.
Okay, let's break down the 4 points you mentioned. The last point is decentralized liquidity problem. So currently, still, it's not a trustless system. We still have to trust the centralized fiat, USDT, USDC. So what's the plan or the infrastructure here provided by Gyroscope that make the system more trustless?
Yeah, a good example of the problem, I think, is uh, in the last year in the USDC DPEG, there was uh, quite a lot of like liquidity that would like kind of be required. Like the main liquidity route might be going through like the Curve 3 pool, which would be a pool of DAI, USDT, and USDC. But the problem with this pool is that if USDC depegs, basically the pool becomes all USDC, and the liquidity to do any trade that like is external to USDC, like the liquidity dries up basically because the pool just becomes overloaded in USDC. And a lot of the other infrastructure for trading other stablecoins plugged into liquidity like this. And so the whole the whole liquidity system for trading like stablecoin to stablecoin, even if the stablecoins were completely unrelated to USDC, the liquidity just broke down because you could no longer route from one to the other through through liquid pools. And what we want, what we do with Gyroscope, how we see Gyroscope solving this is we enable a system where you can put GYD at the center and have kind of like independent trading pools that can route in and out of GYD. GYD kind of like aims to handle the risks to the best extent that you can, and so aims to kind of be as resistant as possible to like individual depegs. And then the individual trading pools that can move in and out of GYD can help you connect to any arbitrary stablecoins. And what happens now if one stablecoin depegs like USDC, it probably shuts down the liquidity in one of these trading pools, but the other trading pools may be relatively unaffected, and you may still be able to route liquidity kind of around USDC instead of through it. And this is something we found lacking last year. And as an example, I think I had a good example in a tweet back then. I was looking up like how would you swap BUSD to USDT, and these are like two stablecoins that were completely unrelated to USDC, but the best quote you could get on chain for doing like this swap involved basically like huge amount of market impact, kind of on the order of like 10% plus market impact, which just becomes like kind of undoable for stablecoin to stablecoin liquidity.
Right. So, just a random point, because you mentioned about swapping BUSD to USDT. I usually use DeFi to find the best route. Yeah, anyways, that's another topic. Yeah, so I know that Gyroscope have this dual currency system, which one is GYD, another is Spain. Spain is more on the governance side. We could touch that later. So the GYD, so why does like adding another token as kind of the hook in the system could stabilize um, the system or
You mean
prevent
the
it,
GYD
make
token?
it, yeah.
Yeah, so GYD you can think of as basically if you want to hold stablecoins, GYD is a tokenized way to like to hold it in like the best risk diversified way, is how we like to think of it. It's a stablecoin in its own right, but like it's also just like a means to manage the risk of holding stablecoins. And so it's fair to think of it from either perspective there. Um, and I mean that kind of like explains like why GYD, I think. But I think your question was also about like what does having GYD how does that help stabilize like the trading system?
Yeah, what does tokenizing the other components into GYD actually means?
So for GYD, um, if you want to hold stablecoins, we think you should hold GYD because it has the best risk profile and manages the risk profiles of like of on-chain assets and holding other stablecoins. How you would acquire GYD is you would basically come in with other stablecoins, or in particular assets that the GYD system wants to hold like on its balance sheet, kind of in the assets backing its system. It has various rules about like what exposures it can take on, and so like it you can think of it as uh, the system telling you as an outside user what exposures does the system want to take on? What sort of room does it have in its like balance sheet portfolio? And if you want to mint GYD, you listen to what the protocol is saying, and you can provide the assets that it wants. So things that help it continue to obey like its diversification rules, for instance, and you can use those assets then to like buy newly minted GYD. And why you might want to do this is because uh, it helps you manage your own risk exposure. And then you can use the GYD in eventually whatever DeFi protocols you want to use, as soon as like more integrations happen, and you can be less concerned, I guess, about like the risks of your assets in those other protocols, because you have this extra layer of risk management that happens in GYD itself. It takes care of that challenge for you, so that you don't have to. You can just focus then on how you actually want to use the stable coins you actually hold, as opposed to trying to manage like different exposures between different types of stable coins. It also does the same thing from a yield perspective, so that's like another reason why you might want to hold GYD. There's the system itself like kind of holds balance sheet assets, but it also deploys those balance sheet assets to different places that can earn a yield, and uh, the same sort of diversification rules apply to like the yield sources as they do to the assets themselves. And so we aim for like the yield that the system actually earns on the balance sheet to be like kind of the best risk diversified yield in DeFi. And eventually, like very soon, there'll be what we call like an SGYD, like a savings version of GYD, that will basically serve as a vehicle for anybody to be able to access like this risk diversified yield potential. And so you can think of it as both managing the risks of your assets, and also like helping to manage the risks of different yield sources in whatever you're trying to do with your stablecoins.
So is that where the decentralized governance come in terms of knowing your risk exposure and tokenizing um, your other stablecoins into GYDs?
Yes. So I mentioned something about like automation earlier. There's only so many things, yeah. There's only so many things you can automate. Um, you can think ahead about like what's going to happen to a given mechanism and how the system should respond if that thing happens. But some things you just can't sort of like predict ahead of time. And one of those things is like, how is DeFi as a space going to evolve, and how is the stablecoin asset space, how is that going to evolve? And so this is what we see as kind of like the primary like role of governance in an ongoing way, is uh, making kind of the decisions that about the system that you can't automate, but importantly, making these sort of decisions, making them as slow as possible. So the thesis is basically automate what you can, and have it happen automatically. For things that you can't automate, which is kind of like slow movements about like the evolution of crypto, um, make it okay for that to be like a slow, deliberate sort of like process. And we expect governance to be like a messy process. This is what happens in decentralized governance systems, and it needs to be okay for the decision making in those sort of processes to be like slow. And so we don't want it to impact kind of like immediate health concerns, but we want it to be able uh, to make kind of slow decisions as the space actually changes, to keep up with the space.
Right. Yeah, I think that's quite detailed of your explanation. So I think it would be super interesting if we could go into more details about like how decentralized monetary policy play with the governance. But I think we're short of time today. So I think my last question would be, um, so so people for me, I think the best product in the current time is actually stablecoins, but in the sense of USDC and USDT, because people in the emerging economies, especially people in war zones or geopolitically shaky zones, they could use USDC and USDT. So I also really admire the idea of non-custodial stablecoins, I think it's a great ideal. Um, so I think the last question will be more of high level questions. Like how would you define like kind of your motivations of building non-stable, non-custodial stable coins, and what should be what should a regular folk like me be thinking ahead in terms of having this non-custodial finance in the future, as opposed to letting the market be dominated by USDT and USDC.
Yeah, that's a great question. The thing I want to focus on there, I think, is about kind of like the innovation potentials. And uh, there's a lot of things you can do with like kind of crypto native infrastructure that you can't effectively do with like off-chain stablecoins. And uh, I mean, decentralized stablecoins have kind of struggled to like actually compete with with things like USDC and USDT. But if you're clever about how you're building things out, uh, you can potentially do actually like quite a lot better than things that are off-chain stablecoins. Maybe like a good example here is one is on risk. So for off-chain stablecoins, you basically always have like the issuer risk. You can't really get around that, but you might be able to do better than just accepting the issuer risk. And that's what we were kind of building all this diversification infrastructure for GYD and kind of the various automations of the policies behind the system and like how the system actually maintains its balance sheet. And we think you can do better than that, than centralized stablecoins. And another area is on liquidity. So maybe a good example here is, let's say you're coming out with a new centralized stablecoin, and you want to build up liquidity for that stablecoin. It's going to be just as hard for you to compete with like USDC and USDT in terms of liquidity as it is for other like decentralized stablecoins today. But you also have like a further almost like handicap, which is that your your the issuance structure for your stablecoin is like very rigid. You basically can only issue the stablecoin through this off-chain process, like by holding dollars or holding T-bills or something. But it's like quite a defined process. But you can, if you're doing it instead as like a crypto native sort of infrastructure for issuance, you can potentially do quite a lot more in terms of being able to bootstrap liquidity. One example is kind of innovations around like protocol owned liquidity and being able to just like inject kind of like liquidity directly into markets, almost like a central bank might do. It basically unlocks like some central bank like actions around bringing a stablecoin to market, which can have a lot of advantages. It can also have a lot of risks, but like that's why we're focused on making sure that that the risks are properly considered in what we're rolling out. So that's yeah one like sort of big motivation. It's just like all of the innovation potential that we see. We think you can do better than a lot of centralized stablecoin solutions, and that's what we're aiming to do. You can also get all of these just like very neat properties, I guess. And some people care about them, some people don't care as much, but about just like kind of like the unique properties of DeFi, which resonate a lot with us, and we think also like adds a lot of value. And this is like basically the potential to have like an actual like non-custodial money, something where you're not just like making a direct sort of like counterparty risk exposure. And you're also not just like necessarily holding dollars, but maybe you have something that can turn into like an actual like independent currency someday. I think that has quite a lot of potential, and is like just another reason to be like very interested about like what can decentralized stablecoins become. And then there's all of the things you can do with DeFi and plugging like stablecoins directly into DeFi applications, things that you also can't do with with centralized stablecoins in the same way. People who are holding centralized stablecoins can do it, but if you have a crypto native stablecoin itself, like the protocol itself can integrate with like a bunch of other things. Um, and this I want to bring it back to risk again, since like that's kind of like one of the main points. You can doing this means taking on a lot of risk exposure, and means making like complicated DeFi sort of systems or systems that are more complicated because they interconnect more. Um, but this is why we want to bring in sort of like our research perspective and basically help to make the sort of complicated DeFi systems that like you kind of need to be able to compete with things like USDC and USDT, because basically like you can have something super simple, but either it's not going to be competitive because like it doesn't get you all of these like sort of like benefits that can help like balance against sort of just like the market size the USDC and USDT already has, or you're actually just like ignoring the risks, pretending like they're not there and sort of like just painting over it. But they still exist and they might sort of like break through the paint someday. And so either way, the way we see it is like these sort of like complicated DeFi systems are inevitable, especially if you want something that can compete with centralized stablecoins. And we want to make it in the safest possible way, and that's what we're kind of like adding to the space.
I see. So what do you think would be the breaking point of non-custodial stablecoins actually becoming crypto native? Meaning the reserve can be crypto native.
For for our approach so far with Gyroscope, we've basically just taken stock of the crypto asset landscape, accepted it for what it is, and tried to sort of like categorize all the different risks uh, that are present. And one of the main categories, I guess, is like kind of decentralized risk factors. So things that are coming from like very close to like actually decentralized assets, or they are actually like fully decentralized. And on the other side, centralized risk factors. So this is stuff where you have like centralized stable coins, and we see there being complementary value because those are like different risks, and because they're different risks, they help you with diversification. So actually, I don't think we would suggest ever completely removing custodial assets, but always trying to balance what are the risks of custodial assets and what are the risks that are coming from other decentralized assets, and do the best that you can in terms of diversifying those risks.
Wait, so before letting you go, I think the last question would be, who are the heavy users of Gyroscope stablecoins right now?
Right now, the biggest users are liquidity providers. That's likely to change soon with the rollout of like the SGYD, the version that'll help people get access to like the diversified yield source. But currently, um, basically, we have what we think of as like a risk diversified like LP tool. So what I was saying before about like this liquidity structure, where you can have like independent pools for moving in and out of GYD through various different stablecoins, it helps on two fronts. It helps on the original front I was saying about like just making the routing challenge in like a possible like stablecoin depeg scenario, help making that more robust. But it also has the same effect on like liquidity providers themselves. So if you're a liquidity provider for like stablecoin to stablecoin pairs, but you want to mitigate your exposure uh, to what would happen if like an individual stablecoin depegged, so for example USDC, uh, you would choose an allocation like across these like pools that are moving in and out of GYD, and kind of the worst that can happen is basically one or some of those pools like kind of go down if an individual stablecoin depegs, but the other pools are like as independent as possible. You're gonna have like less exposure to the depeg, uh, and they may even like continue functioning. You may still be getting like trading fees. So this is like a comparison against like being an LP in like the Curve 3 pool and being an LP in this sort of more diversified like LP structure. So if you were an LP in the Curve 3 pool, in the USDC DPEG, you would basically be left holding the bag of USDC, and your portfolio value would take quite a hit because that's just like the LP strategy you committed to. But if you're managing your exposure through diversifying across these GYD pools, then you wouldn't have that same exposure, and you would still have independent pools that are as unrelated as possible, and so your portfolio would be less would take less of a hit.
Right. Okay, I think we are running out of time. And yeah, thank you so much for the time. And I think I learned a lot today.
Yeah, of course.
Particularly enjoyed the first part of the interview where you mentioned a lot of the high level stuff, and it really helped me to understand what's going on in the stablecoin space, I think.
Yeah, happy to be help, and thanks for having me.
So I'm not gonna take more of your time. Thank you for your time today, and I'll keep you updated on the Telegram chat.
Sounds good. Thanks.
Great. Bye bye.